All right, hello and welcome back. For the next company, Fireside Chat, we welcome VitalHub, who trades under the ticker symbol VHI on the TSX and VHIBF on the OTCQX. And joining us today from the company is Dan Matlow, the company's Chief Executive Officer, and Brian Goffenberg, the company's Chief Financial Officer. Dan, Brian, welcome.
Welcome. Thanks for having us today.
Great. Wonderful to have you guys here today. For those a bit new to the company, provide everyone with an overview of the company.
Yeah. VitalHub is a internationally based organization, headquartered out of Toronto, Canada. But we do have customers and operations in the UK, Mideast, and Australia-based marketplaces, as well as Canada, of course, to do that. And over the last 7 years, we've been building up this company that's really been focused on a two-pronged strategy in the healthcare IT software space of an M&A strategy of combining companies together in a synergistic fashion. And we've done 21 acquisitions on inception. And of course, because they're synergistic assets, we really think organic growth as an important aspect of it as well. So we're focused on both of those as healthcare IT software, really focused across three different areas: patient flow and operational visibility solutions. Those are solutions that help organizations focus on the movement of patients and the effectiveness of the movement of patients across the entire continuum of care, which is a healthcare term that we would use to describe the movement of those patients. So we do that by both combining analytics that healthcare organizations can understand how the movement of those patients are going on, as well as patient engagement platforms, tools that are used by patients themselves to help them navigate through that healthcare facilities a lot more effectively. And that's been our biggest source of revenue, with about 65% of revenue coming from that area. We also are heavily involved in what we call community health agency-based systems, electronic client record or health record solutions for those based systems. And then a new area which we've gone into is workforce management systems. Those are systems that are used by employees of healthcare systems to help them do their jobs more effectively, and things like recruiting systems and compliance-based systems in those areas. So we've been looking to get those and build a puzzle of those solutions that we can really get a compelling narrative to those healthcare organizations in exchange for some growth and opportunities for there. And we've been pretty successful at that today.
All right, excellent. Let's, maybe for today's discussion, let's kind of divide it between the two strategies you talked about, that two-pronged strategy of organic growth opportunities within sort of your product suites, and then pursuing sort of this aggressive M&A plan. And maybe we'll start on the organic side first. The company is currently focused on sort of single-payer healthcare systems. Why have you chosen this to be the strategy?
I personally have a lot of experience in the private healthcare system in the U.S. That's actually where I started my roots in that. And then, when about halfway through my career, we started focusing on organizations from a Canadian perspective. And we had a predecessor company called MedWorks that was also publicly traded and was sold off to a Vista Equity Partner based organization, I think in 2016-ish. And then we started VitalHub thereafter. Exposure to the single payer system just really illustrated that it was primarily serviced by what I'll call small cottagey type of businesses that might have sprung out from the healthcare organization themselves or consulting groups, but very entrepreneurial based, that were building niche type solutions to do that. And really the thought mentality was that the combination of those solutions would do a lot more effectiveness in those markets than these niche solutions. And that's where we really got the idea, is that really combining those solutions in those marketplaces. We don't see as many of those niche solutions in a U.S. marketplace that would have a bigger TAM and a bigger marketplace. And tends to get, because that bigger TAM tends to get a little bit more focus on venture capital funding or private equity based funding to help it grow. So we really don't see that as much in the single payer systems. And again, why we thought an M&A strategy would be pretty effective there.
Okay. I want to come back to sort of the product portfolio, right? Maybe you expanded a little bit upon it in your introductory remarks there, but maybe dive a little bit deeper into the current product portfolio.
Yeah, again, as I said, the patient flow and operational visibility from a statistical perspective would be one of the, we think being the hottest trends within healthcare in its present base time. The use of digital assets in terms of understanding how the inventory, which is us as patients, is flowing through a pretty complex navigation process is a pretty important analytical based platform for administrative people within those organizations, especially in a single payer system where you're really trying to really increase the effectiveness of how well we get those patients through the system and as fast and we get them through with high quality of service. Really, quality of care is really what the byproduct is that healthcare wants. And but they got capacities from funding and from other areas in terms of how we can flow those patients. So how we utilize those resources, resource management is really depending on analytics and timely care from those areas. So a lot of byproduct solutions have really derived off of that thought process of what that value proposition, coming from departmental solutions within hospitals themselves, be it emergency rooms, radiology systems, et cetera, through to regional-based solutions where we're looking at analytics to help us understand where capacities are from one hospital to the next hospital or from the next community care system right through to referral-based systems where we can electronically refer patients from one to the area and effectively attach them and really connect them from one area to the area. And then engagement-based systems, so us as a patients, how we engage with our healthcare organizations through our phones or our computers to really streamline that we don't have to go in and really get telephone conversations or forms by fax or going in to fill out particular material either post or pre-care from those organizations. So there's lots of different solutions that really look at those pathways of how those patients flow through those organizations, and we've really accumulated a fair amount of solutions to do that. The second area of strategy is community care-based systems. So in between a doctor's office, physician practice on the low end through to the high end systems of a big, teaching acute care hospital or trust, as they would call them in the UK, would be community agencies. So mental health, addictions-based areas, services, rehab facilities would be areas that we would sell complete ERP-based systems, community systems. And we have a product called Treat, which is our go-to product in that market, which has done extremely well in the Canadian marketplace as a go-to product in those particular areas. And we've won some very large procurements in things like provincial deals, like the province of Nova Scotia, as well as like the jail system, the penitentiary system in the entire province of Ontario, as well as numerous other deals that we continue to win business on to do that. And the last area, we've only done really two little acquisitions of an area is in workforce management. So, employees of hospitals or contractors really have a lot of compliance-based issues, and they're unique type of workers that would, need to have a lot of compliance and recruitment-based systems and e-learning type of systems to really enforce what they do. And we have solutions that would do that as well.
All right, excellent. Let's sort of get more into the contract structure. Talk about sort of the recurring revenue profile of these contracts and how you do structure them.
Yeah, we structure anything new, although when we acquire, we tend to inherit some of what their structures are like. But our ideal process would be a 5-year recurring based license-based agreement on a SaaS-based recurring based model that we do. We try to move to those directions. We do inherit all different types of license agreements, but inevitably recurring revenue is really from an economics perspective of what we're all about. And 80% of our revenue is recurring. And, we've really gotten that number into the 70 million-ish range of recurring revenue that we have out as our our core base offering. So recurring revenue is really at the core of what we're all about.
Okay. In terms of sort of opportunities for growth this year, again, we're talking more on the organic side. Talk through maybe some of the biggest opportunities you see.
Typically our, what we strive to do is to get a good, healthy base level of organic growth. And we run our company on the concept of the rule of 40. So we're either looking at on the top or the bottom line, and we successfully have done that for about 2, 3 years now. In terms of we've done and continuously, grow our bottom line and our free cash flow of what we have. And we think the business model has a lot more growth potential that really does that. But we've been working on like a 23-17 model on the growth side. It's really been as we get bigger, the denominator is growing, and it's more of a 25-15 or 26-14 type of model as we continue to grow. But we've been seeing some pretty large organic growth. ARR, I think for the last 8 quarters, on average, has been about 1.5 million of new ARR organically from every quarter. It's not what we purchase; it's what we add to what we purchase. So about 1.5 million, per quarter. So it's been pretty healthy, metrics that we've been offering our shareholders to get a good view at.
Right. You've brought together a number of these different platforms here. Talk about how you cross-sell within sort of the product portfolio.
Cross-sell is a pretty big part of what our go-to-market is organic, and it's a large amount of what our new organic growth is. We cross-sell, based off of different product sets, but the same buyer or similar buyers that would do that. So systems that really relate to one another, and really we look, if we're in for one project, we try to entice for multiple projects as we continue to move in those directions. So we do cross-sell. We also look at cross-sell from a geographical perspective. So as I said, we're in 4 different geographies. So there are certain products that might have been UK based that we bring over to the Australian or the Mideast or the Canadian market, or vice versa. Products that were Canadian based that we bring into other markets, or acquisitions that may have already had footprints in some of the markets that we've already been into, but we can enhance a little bit more with more feet on the street and better distribution in those channels. So all those are important aspects of our organic growth strategy.
Okay. You mentioned Canada, you mentioned the UK, you mentioned the US. Maybe talk a bit about geographic breakdowns and sort of where you're targeting, maybe outside of some of the core areas or regions of focus here.
Yeah, we're Canadian based. Approximately about 50-55% of our revenue is in the UK. 30-35% of our revenue would be in the Canadian marketplace, and the rest would be in the Australian and the Mideast area. So it's been a concentration on Canada and the Mideast in the UK, but we do have pretty good footprints in Australia and Mideast, and we look to expand and growth in those areas.
Okay. I was doing some more here. Talk maybe a little bit about the strategy with the Innovations Lab in Sri Lanka there.
Yeah, an important area to what we do, and as I said before, we have that metric of the rule of 40, and we're really trying to get things on the bottom line. And as you can appreciate, a big cost for a small business that we would purchase would be their R&D or their tech-based team, and the ability to compete in those levels and trying to upgrade those teams is sometimes a challenge. So we have about 500 employees in the company now, and about 180 to 200 of those are in Colombo, Sri Lanka, where we have our what we would label as our innovations lab, where we do anything from development, QA to support to IT support, and even doing a little bit of accounting there. And it's a pretty cost-effective based tool that we have for both innovation and cost reduction for those assets that are important for us to do. So it's an important ingredient, and it's part of our secret sauce of how we've had really success in producing the numbers that we have.
All right, excellent. Maybe just one final point to make sure we hit in on before we transition over to sort of the M&A strategy. You talked about the rule of 40. Where are sort of EBITDA margins at here in the next 5 years or so?
We're always going to think we're going to talk on the rule of 40. Maybe it goes up a little bit or down a little bit there, but we're really trying to target that rule of 40. And anything above that, we want to reinvest into the company. So, we expect as we make acquisitions and do more work, we expect free cash flow to continue to increase and our EBITDA margins and continue to increase, or at least the dollar volume, increasing. And, as a result, that we believe the share price should move correspondingly with that. So we're sitting in a pretty good position, in our balance sheet right now. We just completed a $30 million raise, which is closing this week. And, it's well north of 80 something million in the bank to go do that. But our EBITDA margins should consistently go up, right? And those things going up as we keep working to get cost reduction and get organic growth increasing within our base.
Every time there's an acquisition, you'll probably see some of the margin go down slightly as we absorb that and get synergies as we go through.
Right. Okay. No, that makes sense. Well, so let's transition that to the M&A side, right? With sort of this free cash flow. Then, talk about your overall M&A strategy.
We have our own internal group. We source our deals. Although, over a period of time, we've gotten some brand out there, and we do get approached with a fair amount of deal flow at this point in time that we look at. But we're pretty careful buyers in terms of what we do. We look to get a payback within about a 4 to 7 year period of what we pay for those assets. And we won't touch anything that doesn't have at least 60% recurring revenue. We like them to be synergistic. We're looking for areas where we can leverage our innovations lab as effectively as possible, and where we can get synergistic value from all different areas of our business. So synergistic is really, valuation is really based on what we can do with the company. We might do an acquisition and, they look at it and they go, wow, why did you buy that business? It was actually losing money and you can't get it. And then a year and a bit later, it's like, it's really, really profitable, right? So it's a question of what we can do with that business and how we think we can, restructure it or realign it is a big part of what we do.
How are you finding the sort of the current M&A environment? The competition for deals and such. You just talked about sort of the valuation, what you can do with it, but how are you finding the overall environment?
I think we're in a little bit of a unique, situation. We'll buy things as low as, $1 million in revenue, and, it's probably as high as 40, 50 if we ever find those things. But probably our sweet spot is, 4 million to 8 million in type of revenue type businesses, which really is somewhat of a barrier sometimes to private equity and, VC-ish type places that would really have the capital to buy those things, but they'd be a little bit scared to buy things at those levels because they wouldn't feel comfortable in operating those businesses in case there was attrition in terms of the brain trust of those businesses. Our methodology is really we got a lot of brain trust and we really understand the domain really well. So those businesses snap into us, and if we lose principals, so be it. That's not what ideally we don't want that to happen, but we can absorb those businesses from a risk profile to do that. So it really gets us, I think, in a little bit of a nice competitive position in those competitive marketplaces pretty nicely in those niches areas. Of course, as you get bigger in size, it will attract a different type of buyer with private equity and so forth. But we still think we bring a lot to the table in terms of our domain experience and our ability and synergistic offerings. And we think we provide a really compelling and really nice home for those entrepreneurs that are looking for a nice place to put their businesses.
Maybe expand upon that a little bit. You've done a number of acquisitions. How do you integrate these acquisitions and realize the synergies?
We put everyone on our same methodologies and our same software products and our same metrics. We do have, we measure performance, we measure output, and we have the ability to put, a good playbook and processes in place to really integrate these things. Where applicable, we'll do technology integration where it makes sense to fit those things. We'll take best components of products and move them from one product to the other from a technology perspective. We'll synergize sales. We'll synergy sales and marketing. We'll move corporately. We'll own all of IT. We'll own all of finance. So we do integrate the companies. We don't leave them standing alone. We integrate it into our whole operations, but at the same time, we want to make sure that we don't lose the goodwill and the expertise of those base organizations or the brand that they've established over the years.
All right, makes sense. Maybe final topic here on the M&A front. Any sort of thoughts on expansion into the U.S.?
Yeah, maybe the last acquisition we had a little bit of a flavor in the U.S. and for the last couple of them that we've done, and we are starting to get a little bit more size and scale where the U.S. could present some opportunities for us. So where probably 2 years ago I would say definitely not into those markets until we got some size and depth. I think we're starting to approach that level where U.S. we could start moving into that area a little bit more.
All right, perfect. Maybe just taking a big picture, wrapping things up here. Where will VitalHub be in 5 years?
Listen, if I look at the trailing 5 years and I put those next 5 years forward, in thinking that we could put some bigger deals into that equations, our goal is to be a 100% cash compounder where we don't have to raise money to do that, or where our earnings are really allowing us to do more acquisitions. And we're sort of borderline in that areas right now. It just depends on the size of the acquisitions. But, we are, if you take our third quarter and, look at that from an annual basis, it's getting close to 18, 20, and probably without doing any more acquisitions, should start hitting the 25 million level, during the 2025 year. So we are starting to produce some significant cash, and we have cash on hand to do deals. So it should be able to let us to do a significant amount of deal flow with just what we have right now. We also have a debt facility of 60 million. So using those resources to do that, it doesn't mean if something bigger or other opportunities that we wouldn't go tap the markets, but really 5 or 6 years from now, I would expect us to be a totally funding everything based on our own cash flows by far, and really becoming one of those true compounders.
Got it. All right. Well, look, we're sort of wrapping things up here against the clock. Closing comments, takeaways for investors.
Yeah, I think our investors, the stock has had a pretty good run over the last year, and I think it's really because investors have really recognized our business model. And if you believe in the business model, we believe it's still a very good, midterm to long-term investment that investors can get themselves into and be involved with it. So we do expect to continuously grow our metrics and continuously expand on those metrics. And if those happens, the stock price should go up accordingly with that. But really, I think we're primarily institutionally held. And we've had a lot of very smart people dig into our business model and have appreciated it and have valued it. And, we're looking for any new investors that want to learn a little bit more about that model and follow that model. And we're always available for those discussions to go through that. But really, you're buying into the model, and that's what we're all about.
Fantastic. All right. Well, we will leave it there. Dan, Brian, thank you very much for your time today. And I want to thank everyone for watching. To Dan's point there, if you have any questions or would like to schedule a meeting with the company, I'd be happy to coordinate. Send me an email, Blum, BLUM, @lythampartners.com, or I'm sure you can reach out to the company directly here as well. We have a few more presentations and Fireside Chats coming up again, so don't go anywhere. Again, Dan, Brian, thank you so much for your time and participation in the conference here today.
Yep. Thanks for having us.
Great. Thank you, everyone. Have a great rest of your day.
Bye-bye.